On January 1st, 2026, the federal exemption limit that protects ordinary assets from aggressive taxation drops by half. Millions of older property owners are rushing to shield their homes using standard legal vehicles, unaware they are triggering a silent banking trap. Under Title 12 of the United States Code, Section 1701J-3, lending institutions possess the absolute legal authority to demand immediate and full repayment of your mortgage if you transfer your property incorrectly. They are aggressively monitoring county recording offices right now for these specific transfers. You have a narrow window to secure your home. The margin for error is zero. President Ronald Reagan signed the Garn-St Depository Institutions Act into law in October of 1982. Congress wrote this legislation during a period of intense, suffocating economic distress. The national average for a 30-year fixed mortgage sat at a staggering 18%. Savings and loan associations faced total collapse. They held millions of older mortgages fixed at 4 or 5%. Depositors demanded high yields on their savings accounts, but the banks earned almost nothing on their legacy loan portfolios. Congress handed the banking industry a massive legal weapon to fix their balance sheets. The law explicitly authorized banks to enforce due-on-sale clauses across the entire country. A due-on-sale clause allows the lender to demand the entire remaining balance of the loan the moment the borrower transfers the property deed. Banks use this clause ruthlessly to wipe out the old, low-interest loans. They force buyers into new 18% mortgages to survive. Fast forward to today. The economic landscape mirrors the exact pressure points of 1982, just in reverse. 10 years ago, homeowners locked in mortgage rates at 2 or 3%. Current market rates hover around 7%. Lenders despise your 3% mortgage. Every month you pay your mortgage at 3%, the bank loses the opportunity to lend that same money to someone else at 7%. They want your loan off their books permanently. They cannot simply cancel your contract. They need you to make a procedural mistake. The pending 2026 tax law changes provide the perfect catalyst for that exact mistake. On December 31st, 2025, the Tax Cuts and Jobs Act expires. The lifetime estate and gift tax exemption will plummet from over $13 million down to approximately $7 million. Financial planners are currently terrified of this approaching cliff. They instruct their older clients to move real estate into irrevocable trusts to remove the asset from their taxable estate. This action hands the bank the exact legal trigger they need. The secondary mortgage market dictates these rules relentlessly. Entities like the Federal National Mortgage Association, commonly known as Fannie Mae, purchase your loans from local banks. They bundle these loans into massive securitized trusts. The local bank simply acts as a servicer collecting your monthly payments. Fannie Mae sets the strict servicing guidelines that the local bank must follow. If the local servicer fails to enforce a due-on-sale clause when a title changes, Fannie Mae can penalize the servicer. The servicer faces massive financial liability if they ignore the rule. They are highly motivated to catch your mistake. They employ thousands of compliance officers simply to monitor these specific title transfers. You cannot hide a recorded deed. Margaret is 71 years old. She lives in a 2-story brick colonial in Shaker Heights, Ohio. She and her late husband Thomas bought the house in 1989 for $142,500. The property features a detached garage, original hardwood floors, and a massive oak tree shading the front porch. She holds a tremendous amount of physical equity in the property. 5 years ago, she refinanced her remaining balance to secure a 2.8% interest rate. Her current principal balance sits at exactly $78,400. Thomas passed away last November after a sudden, devastating heart failure. Margaret faced the terrifying reality of managing her long-term financial survival entirely alone. Her accountant warned her about the 2026 tax sunset and suggested she protect the house. He told her to execute a quitclaim deed immediately. He instructed her to transfer the property title from her individual name into the Margaret Ann Family Irrevocable Trust. Margaret followed his instructions perfectly. She paid a local attorney $1,200 to draft the trust documents. She drove to the Cuyahoga County Recorder's office and filed the new deed on a Tuesday morning. She believed she had secured her children's inheritance forever. 34 days later, Margaret received a certified letter from her mortgage servicer. The letter referenced her original promissory note and cited the due-on-sale clause explicitly. The bank declared her entire $78,400 balance due and payable in exactly 30 days. The letter offered no payment plan. The bank demanded a wire transfer for the full amount. Margaret experienced a full-blown panic attack at her kitchen table. She possessed only $14,000 in her liquid checking account. Her monthly Social Security check barely covered her groceries, her utility bills, and her $412 mortgage payment. She called her mortgage servicer begging for an explanation. The customer service representative calmly explained that transferring the home into an irrevocable trust violated her original loan agreement. Margaret lost her 2.8% mortgage. She had to take out a new loan to pay off the old loan. The current market rate forced her into a 7.2% mortgage. The mistake destroyed her monthly budget. She did not act out of malice or fraud. She simply followed standard tax advice without understanding the banking implications. The local attorney drafted the trust perfectly according to the state law. The accountant calculated the estate tax perfectly according to the federal code. Neither of them warned her about the mortgage servicer. They operated in their distinct professional silos. The bank capitalized on the gap between the tax code and the banking regulations. Margaret became collateral damage in a corporate effort to purge low-yielding assets. She lost thousands of dollars because she lacked the complete picture. The system punishes the uninformed. You need to understand the exact text of the law to defend yourself. The Garn-St Act contains a list of specific exemptions designed to protect consumers from aggressive banking tactics. These exemptions reside in Title 12 of the United States Code, Section 1701J-3, subsection D. The statute explicitly prohibits a lender from enforcing a due-on-sale clause in certain family and estate planning scenarios. Paragraph 8 of that subsection contains the trap. The law protects a transfer into an inter vivos trust. The term inter vivos simply means a trust created during your lifetime. The protection contains a strict, non-negotiable condition. The borrower must remain a beneficiary of the trust, and the transfer must not relate to a transfer of rights of occupancy in the property. You must meet every single word of that requirement. When you transfer a home into a revocable living trust, you remain the primary beneficiary. You retain total control over the asset. You maintain your right to occupy the property permanently. The bank cannot touch you under these precise conditions. The federal statute completely shields this specific transfer from banking interference. An irrevocable trust operates under entirely different legal mechanics. When you place a home into an irrevocable trust to protect it from Medicaid recovery or to remove it from your 2026 taxable estate, you surrender control of the asset. You often name your adult children as the primary beneficiaries. You sever your direct legal ownership to satisfy the Internal Revenue Service. The moment you sign that specific deed, you strip away your federal banking protection. General practice attorneys and local accountants miss this distinction constantly. They focus entirely on the tax code and completely ignore the banking statutes. They read Internal Revenue Code Section 2036 regarding retained life estates, and they fail to cross-reference Title 12 of the United States Code. You pay them for their advice, and you absorb the entire financial penalty when they are wrong. The federal regulations grant the bank the power, and the bank will use it. Furthermore, moving the property incorrectly can destroy your capital gains exemption. Internal Revenue Code Section 121 allows a single homeowner to exclude up to $250,000 of profit when selling a primary residence. A married couple can exclude up to $500,000. If you transfer the house into an improperly drafted irrevocable trust, the trust becomes the legal owner. The trust does not live in the house. When the trust eventually sells the property, the IRS denies the Section 121 exclusion. You owe long-term capital gains tax on the entire profit. This creates a secondary financial disaster layered directly on top of the mortgage acceleration. You lose your low interest rate to the bank, and you lose your tax shelter to the federal government. This happens because professionals fail to communicate across disciplines. They treat estate planning as a series of isolated documents. They do not view your financial life as an interconnected system. The bank understands the system perfectly. The Internal Revenue Service understands the system perfectly. You must understand the system to survive the coming changes. Let us look at the exact mathematical destruction this causes. We will run two complete calculations based on Margaret's actual financial reality. Margaret holds a mortgage balance of exactly $78,400. Her original loan term leaves exactly 14 years of payments remaining on the schedule. Her fixed interest rate sits at exactly 2.8%. Her monthly payment for principal and interest equals $566.14. Over the remaining 14 years, Margaret will pay exactly $16,711 in total interest. This represents a highly efficient, low-cost debt structure. She retains maximum control over her fixed monthly income. This is the baseline scenario if she simply uses a standard revocable trust. Now look at the penalty scenario. Margaret transfers the property into the irrevocable trust and triggers the acceleration clause. She must originate a new mortgage immediately to satisfy the bank's demand. She borrows the same $78,400 to pay off the called note. She takes a new 14-year term to match her original amortization timeline. The current market interest rate stands at 7.2%. Her new monthly payment for principal and interest jumps to $739.42. This represents an immediate monthly increase of $173.28. She must pull this extra money directly from her fixed grocery and utility budget. She also pays $4,200 in origination fees and closing costs just to secure the new loan. Over the 14-year term, her total interest burden explodes dramatically. She will pay $45,822 in pure interest to the new bank. She loses $29,111 in additional interest costs, plus her closing fees. She effectively burned $33,000 of her hard-earned home equity. Let us examine the tax mathematics under Internal Revenue Code Section 121. Assume Margaret bought the house for $142,500. The current market value sits at $390,000. If she maintained ownership through a revocable trust, her $247,500 profit remains completely tax-free. The IRS cannot touch a single cent of that gain. By transferring the deed into an irrevocable trust without a grantor trust provision, the trust assumes the capital gains liability. The trust tax brackets are brutally compressed. The trust pays a 20% capital gains rate on the profit. The federal tax bill alone totals $49,500. Add the $33,000 mortgage penalty, and Margaret destroyed $82,500 of wealth. This money vanishes from her family legacy forever. She cannot leave those funds to her grandchildren. She cannot use those funds to pay for in-home medical care. The bank and the government legally extracted $82,000 from her net worth simply because she filed the wrong type of deed. The math is brutal and entirely legal. Margaret represents a tiny fraction of a massive national trend. 10,000 Americans turn 65 every single day in this country. We are currently entering the largest generational wealth transfer in human history. Millions of older homeowners hold trillions of dollars in real estate equity. They also hold millions of low-interest mortgages originated before the recent inflation crisis. Financial institutions employ automated software to monitor county property records constantly. These systems scan daily for title changes, deed transfers, and trust recordings across thousands of jurisdictions. The software cross-references the new recorded deed against the bank's internal mortgage database. If the system detects a transfer to an irrevocable entity, it flags the file automatically. The bank issues the acceleration notice without a human being ever reviewing the physical file. The institutions treat this as a pure, mechanized revenue generation strategy. They view your low-interest mortgage as a toxic asset dragging down their quarterly earnings. They utilize the 2026 tax panic to flush these toxic assets out of their corporate portfolios. You are fighting a machine programmed to enforce the strict letter of the commercial law. You cannot plead ignorance or ask for mercy from an algorithm. This automated enforcement will accelerate massively as we approach the December 2025 deadline. Thousands of estate planning firms are running aggressive marketing campaigns right now. They are terrifying seniors into moving assets rapidly to beat the sunsetting tax provisions. The volume of recorded trust deeds will spike exponentially over the next 18 months. The banks are waiting quietly to harvest the mistakes. The trap is set for you. The deed transfer triggers other catastrophic failures beyond the mortgage acceleration and the capital gains tax. Your hazard insurance policy contains a strictly enforced named insured clause. When you bought your house, you insured it in your individual name. If you transfer the property deed into a trust, the legal owner of the physical structure changes instantly. If you fail to update your insurance policy, You are paying premiums on a voided contract. If a fire destroys your kitchen, the insurance company will investigate the property title. They will discover the trust owns the house, but you personally hold the insurance policy. They possess the absolute legal right to deny your entire claim based on a lack of insurable interest. You could lose the physical home and receive absolutely zero financial compensation. Title insurance presents an equally dangerous and hidden trap. When you purchased your home, you likely bought an American Land Title Association owner's policy. This policy protects you against hidden liens, boundary disputes, and previous ownership claims dating back decades. Standard title policies do not automatically forward their financial protection to a newly formed trust. You must explicitly request an endorsement from the title company to maintain your legal coverage. If a contractor from 10 years ago files a delayed mechanics lien against the property, your title insurance should pay the legal defense. If you move the house into a trust without the proper endorsement, the title company will deny the claim immediately. You will pay the legal fees out of your own pocket. These secondary traps destroy families who think they are fully protected. The banking and insurance sectors rely on your procedural ignorance. You must take immediate, precise action to protect your property and your wealth. You cannot rely on assumptions or verbal promises from your local professionals. Step 1 requires exactly 5 minutes and $0. Walk to your filing cabinet and pull your original deed of trust or your official mortgage document. Locate the specific section titled Transfer of the Property or a Beneficial Interest in Borrower. Read the exact language the bank uses regarding the due on sale clause. Step 2 involves your trust documentation. If you plan to transfer your home, you must secure a written letter from your attorney confirming the trust qualifies as an inter vivos trust under Title 12, United States Code, Section 1701J-3. Do not accept a verbal confirmation over the telephone. Demand the specific legal citation in writing on their official letterhead. Step 3 prevents the automated acceleration notice from ever generating. Before you record any deed at the county recorder's office, you must send a preemptive notification letter to your mortgage servicer. You must cite the Garn-St Act directly in your written correspondence. Provide them with a copy of the trust summary verifying you remain the primary beneficiary and the physical occupant. Force the bank to acknowledge your federal protection before you change the title. Step 4 secures your physical asset against catastrophic loss. Call your property and casualty insurance broker today. Instruct them to add your specific trust as an additional named insured on your homeowner's policy. Request a revised declarations page showing the exact trust name. Place this updated declarations page directly inside your estate planning binder. Step 5 guarantees your title protection remains completely intact. Contact the local title agency that closed your original real estate purchase. Give them your original owner's policy number. Request a successor and interest endorsement to legally cover your newly formed trust. Taking these specific steps eliminates the bank's leverage and secures your home permanently. My name is Walter Barron. I spent 3 decades watching financial institutions build traps that ordinary people cannot see until it is too late. There are dozens of channels on this platform pushing financial content designed to confuse you, to alarm you, or to sell you an expensive product. I do not sell anything. I do not run a private mastermind course. I do not offer premium consulting packages. The only reason Dark Macro exists is to make sure you have the exact information that people inside the system have always had. Ordinary seniors have almost never been told these rules. The banks rely on the asymmetry of information to extract your wealth. I rely on the exact text of the federal code to stop them. The only thing I ask in return for this research is that you subscribe to Dark Macro by Walter Barron so that the next video finds you before the deadline does. Drop your state in the comments below so I can track where these aggressive banking tactics are happening most frequently. In the next video, we will examine the specific IRS reporting trap hidden inside standard retirement account withdrawals. Protect your assets, read the fine print, and never let the system force your hand. This channel provides educational information and does not constitute formal legal or tax advice.